Welcome to the podcast, Creating Value in Travel and Transportation, hosted by Landry Holy, CEO and founder of Fairval. In this podcast channel, we will exchange with entrepreneurs, industry experts, financial institutions, and investors on how they contribute to creating value in various travel verticals, thanks new innovative tech solutions and financial services. So, if you have an interest in travel retailing, hospitality, urban mobility, maritime, aviation and space tech, then this podcast is for you.
Hello everyone and welcome to our podcast Creating Value in Travel and Transportation. Today we have with us Claus Hirzmann, founder and CEO of Strategic Finance, a consulting firm providing finance engineering services and solutions. Claus also works with us as a Fairval consulting partner, where he provides his expertise for some of our missions we deliver to our customers. Finally, on a personal note, Claus was my mentor for a thesis I did on real option. And so today, real option is the topic. And more specifically, through this podcast, you will discover an approach that enables any C-level decision maker or investor to make better and bolder investment decisions when it comes to investing in innovation and generally risky assets such as startups. Hi, Claus. Great to have you here.
Hi, Landry. Thank you very much. It's my pleasure, and hello, everybody.
So, Claus, just to start, could you tell us a bit more about your background and what is strategic finance?
Sure. From my background, I'm an engineer at MBA, and my center of interest are topics like innovation, strategy, and finance, and in particular the intersection of those three topics. And this is where real options really reside, and where throughout my professional curriculum I always found that this is very helpful. And I've been working in multiple international companies where I could really experience hands-on the usefulness of this method. And in particular, I've been working also for a leading IT company in the area of travel and transportation. And to make this method of real options easily available, I've decided to create a company that added software that encapsulates 18 years of expertise in that field and also recent research progress in that field, such that real options finance is really available at your fingertips.
Wow, that is really interesting. So before we jump into what are real options, I'd like to start with a very basic question, which is why of the real options?
Yeah, why do we need real options? And if you look at innovating and at managing operational uncertainties with resiliency, we actually have to face uncertainty. And so to answer the why, I like to quote a saying, which is never test the depths of a river with both feet. This is it, basically, right? What this saying reminds us is that if we're facing uncertainty, we should not just gamble and jump with both feet. No, what we should do is we should proceed stepwise, right? We should do a step, learn something from that progress, and adjust what we're doing next accordingly to what we have just learned. And if you look at this is exactly what you found at the heart of very famous innovation methodologies like scaled agile framework, discovery-driven growth, lean startup, right? So this is what is extremely helpful to reduce risks, to manage uncertainty. Now, the question is this sufficient for investors and C-level decision makers to actually decide to invest? And the answer is no, it's not enough. It's appreciable that we decrease risks, but we still need a valuation, a financial rationale to decide whether we should invest or not. And C-level decision makers and investors are used to this, and the classic method here is net present value. Now, the problem is that net present value is ill-suited for the approach we just described, this stepwise progress and discovery and adjustment, this agile way of proceeding, this is just not properly represented in the net present value metrics, right? And therefore we need a suitable metrics. And the good news is it exists, and their name is real options.
Right. Well, thank you for setting the scene so well. So can you then elaborate what are real options?
Yeah, so real options is a financial metrics to assess value creation, expected value creation. And in that sense, it's, actually the same conceptual method as net present value. Both calculate expected value creation. And the numerical results, therefore, are of the same kind. They compare apples to apples. So where those methods differ is actually in their ability to represent various project trajectories, if you like. So if you look at net present value, this is a metrics that applies to linear projects that have, a clearly predictable trajectory. So this linearity, this prediction means that people are sure about how the project will go from all investments or towards the return, right? So if projects are predictable because they are rather sure, probably in the area of business as usual projects, you will manage them in a waterfall style and you will evaluate them financially with net present value. Now, if we, however, are in an uncertain context like innovation, then we are just thinking we better take a different approach. We won't manage in a waterfall style, but with agility. Stepwise, right? And stepwise progress, discovery, adjustment, right? And real options is here the matching valuation metrics. Now, why is this called options after all? And the reason is because these agile project steps actually have the same key properties as options. And those of you who know what financial options are, stock options are, may readily remember those key properties, which are uncertainty, observation capability, and agile adjustment. So if you look at each agile project step, this project step actually is designed to progress, such as to investigate some uncertainty. So here it is, this uncertainty aspect of an agile project step. And because it has been actively designed to investigate an uncertainty, at the very end, it will come up with an answer. So here we have got this second property, this observation capability, right? So we resolve what was formerly uncertain. And then on that basis, we get to the third key property, which is adaptability or agility, which means that we perform an agile project steering according to the result that we had just observed, learned, and according to the degrees of freedom or the choices we've got available to decide on the next project step. So in a nutshell, these agile project steps can be reasonably well represented as options, and therefore can be perfectly evaluated financially as options. And we call this real options because we are talking here about valuation techniques that apply to real projects and not financial assets.
Right.
Yeah.
So could you just give us some examples on some domains, use cases in on the broad basis, how you use real options?
Well, if you look at the typical users and use cases, I would start with C-level decision makers in corporates. They will benefit from real options for scenario-based strategic planning. for investment decisions in innovation and transformation projects, and also for investment decisions in resiliency, in operational resiliency. And then we've got private equity funds that do perform M&As with leveraged buyouts. And so they will benefit from real options to value startups for investment and exit decisions. And they can also use real options to value intangible assets like patents, or licenses. And then, of course, corporate venture funds and venture capitalists who need to decide about value of startups and investing and exiting. And then all of the above, and also lean portfolio managers, when you look at the SAFE framework, they will actually benefit from the options to dispose of a truly financial rationale to perform portfolio prioritization. Because once you have decided with your business case that an initiative is worthwhile, this does not necessarily mean that it's funded, because you have probably so many opportunities that you have to select. Steve Jobs said we have to focus, and it's not just choosing the right ones, but also saying no to others. And so you need a financial metrics to perform that prioritization, and on that basis you can then allocate funding, and this is then also done with real options metrics.
That is so interesting, and that was why I was so I was really interested to work to really get more depth in knowledge in this domain, because in the MBA you're taught really the basic methods. Today, if you look at the valuation in startups, they've been going up the roof, and now they're going down the roof. And you can see that there is sometimes a lack of rationality. But overall, that seems to be like the magic tool, but I would challenge a little bit that magic tool. And maybe you could give us some sense of, how you applied real option in a real project, ideally in travel and transportation, because this is the theme of our podcast. How you use real option, how it made really the difference by using it in a real project.
Yeah, sure, with pleasure. And yeah, of course, I have an example from when I've been working in corporate strategy for this leading IT provider in the travel and transportation industry. And this was about a new IT project where we wanted to actually enter or be stronger in the US. We were strong everywhere in the world, but not in the US. And we were excited by the perspective to come up with an innovative IT product that could well address that market and really strengthen our position. So when we build such projects, such innovation projects, we actually start with that excitement, with that vision, with this optimum scenario, with that dream for why we like to do that. And it's really important to capture this. First of all, to really appreciate the full potential of what we're talking about. Are we talking about a 5 million business, 10, 20, 50, 100? What are we talking about to begin with? Why should we consider this? Why should we pay attention to this, right? What is the potential? And it's also important to capture that full potential right from the outset, such that we can, really do all our business casing at the very end. And if we ever happen to decide that we shall not do it, right? Like Steve Jobs said, focus. And this means also being able to desist. We can do so without regret. But also, of course, we can have a full understanding of the full potential. So we are, of course, also able to appreciate that potential, and then to put it into perspective of the entire remaining portfolio of opportunities to select which one to use. So very important, this first step. Let's talk about that dream, right? So we capture this by describing it first financially. So what would be, the ideal, in that ideal scenario, what would be our unit prices, our sales volumes, so overall the ideal revenues, what would be good cost containment. So we come up here with, pretty substantial return cash flows. And we also describe our this ideal scenario by the assumptions we have made to get to this scenario, right? What were our assumptions? So what are our uncertainties? And this leads actually to the second step, which is that on the basis of this list of uncertainties, we then actually imagine project steps, agile project steps. And each step is designed to resolve one uncertainty, such that at the end we get an answer, and then we can perform agile project steering. We navigate the uncertainties and see where we get. And so each of these steps requires an assessment, right, about what shall be done. So what is duration? What are the required resources and investments? So this is business as usual, and also what are the possible outcomes and their probabilities, right? So we need here some clear-cut definitions of completion criteria, of result observation, right? And these clear-cut results help us to come up with clear-cut project steering. This must not be fuzzy. Right. So, and once we have described those steps, then we simply assemble them to the entire project. So this means that one assembly path will lead to the optimistic scenario. Other paths may lead to less optimistic scenarios, medium scenarios. So here again, we need to complete the business case with the return cash flows for those medium scenarios or even pessimistic scenarios. And we may even have zero return. And we even may perform an early stop, or we may pivot, right? So the way we assemble those steps is following according to several strategies. The most important is that we make sure that the big investments take place later, once we had the opportunity to investigate assumptions, basic assumptions, and only if these assumptions are validated, we do the big investments. And so this already indicates that this approach dramatically decreases financial risks. Let me give you the example of that I've got in mind from the travel and transportation industry. So we were looking into this exciting IT product for the US, and we had three uncertainties. The first was, well, this is top-notch, really innovative product, and so we were uncertain about the technical feasibility. So our investigation meant actually that we had to build a prototype to find out. And at the end, we could observe, yes, it's feasible or not. So, and of course, for this, we could decide how much time it takes, what resources it requires, and what investment it requires. And the result could be pass-fail with some probabilities. Then a next uncertainty was about the market acceptance. We were not strong in the US. Everywhere else, but not in the US. And the question was, how would the US market respond to this IT product? Would they love it or not? And so the idea was, well, if we had built a prototype beforehand, then we could show this prototype to the potential customers and get a strong feedback. Very good, because this is much stronger than PowerPoint, right? And then so if this step was successful, and only then we would do a first big investment. Only then. And this first big investment was then the creation, the R&D of the first version of this product. Well, you see that this big investment only takes place once the preceding uncertainties have resolved successfully. And then we had a third uncertainty, which was, well, would it be worthwhile to build a full-blown version of this of this product, a version 2, that really would go to the exploit the full potential of this kind of product? And we figured that, well, it would we would do that if we found that the first version has a very good market success, right? So what we therefore did is, in parallel to the R&D of the version 1, we also performed some pre-sales efforts, such that by the end of that step, right, where the version 1 is available, we would also get results from pre-sales about the actual concrete sales outlook. So the sales outlook could be very good with some probability, or good with some other probability. And of course, we can represent this. And then we figured that if the sales outlook is very good, then we have a justification to push the envelope further and to do yet another big investment, and this time in the version 2, right? Such that we could then actually really fully, exploit this market potential. We would be then in a very, very positive market for our product, and we would then have a version 2 that would fully exploit this market potential. Right, and so this would be the way it goes, and then I should also tell that there are also stop nodes, right? So we would have stopped this entire process if we had found that the prototype is not feasible, right? No technical feasibility. We stop. And we would have also stopped if investigating the market response would have been negative, right? And so that's the overall approach. And there are several remarkable things here. First is that, hey, we were able to stop. And when we stop, this is not sign of failure. This is sign of learning, right? And this is not a failure because we had given to our sponsors right from the outset visibility of possible pathways that could lead to stopping, right? And Google calls this fail fast. This is exactly it, right? There is virtue to be able to stop if we find evidence to be better do. Why should we invest more time and resources and money, right? So that's one thing. The second interesting thing is that the entire process is very fast. I'm talking about an entire tree structure of that represents the various pathways that the business could have taken. But actually, this is very fast because what we're doing here is we're describing what could happen, not what will happen. Because describing what will happen in an uncertain situation is virtually impossible. We would go nowhere, no sense, right? So we shouldn't take that approach. Yet NPV would try that. And no, it's really fast because we just tell what could happen. People are very happy to do that. They can do that. They can tell what is a best case scenario, what is a medium scenario, and other scenarios. They can tell that. Right, and then we got to the valuation, and then found that actually it was worthwhile to start the project. And actually, the financial valuation is done by real options. So actually, what this valuation tells us that if we invest in the first step, in this case a prototype, we get a real option on success. And this success is uncertain, but it has a value, despite of being uncertain, right? So the return can be very high, it can be medium, it can be zero, but it has a value. It's not zero. So it's justified. In our case, it was justified to do the first investment, to progress with the prototype, and then to see what comes out of this. This means that the investment decision and investment strategy is agile. It's not rigid. It's not pre-committed as in NPV. So once we have invested in the next stage, which was, the prototype to begin with, then we don't know whether the other investments will be taken. But we will learn this, and if we learn that it makes sense to continue, then we will do the next investment and proceed with the next step, and so on. So we actually progress as long as justified, but we stop or adjust or pivot as soon as we learn it's necessary. So that's, again, a great strategy to mitigate risks and to have a balanced approach to innovation. It's not all or nothing. We are not doing big bets. We are not refraining from doing innovation, but we have the right balance here. And this is actually the point I wanted to make. Overall, the idea here is that with this approach of agility and real option financial valuation, we actually have a fantastic methodologies that allow us to get access to innovative opportunities despite of their uncertainty. And we would never have access if we had tried to approach them with net present value, right? With a waterfall management approach and net present value. By the way, if we did that calculation, the net present value would have been negative, and we would have never done that project. But the real option approach, an agile approach, allows us to proceed stepwise and to have the opportunity to get access to something others couldn't accept. So I do not want to overstress or overuse the word strategic, but this is strategic. This makes really a difference. You can go where others can't go. And what then was also interesting, we didn't stop with this consideration, but as soon as we were able to calculate real option values, then or to quantify the value of an innovative initiative, we can also decide what is the optimum development strategy. And in our case, we were wondering whether it could be better actually to put some of the agile project steps in parallel, such that we achieve earlier time to market, which then turns out to deliver bigger returns, right? So the question was, shall we take higher risks through parallelization, but for the sake of getting greater return? Or should we stick with the initial sequential approach that is less risky, but we are later time to market and therefore have lower return? So what is better? Higher risk and higher return, or lower risk and lower return? And you can answer this as soon as you're able to quantify. You can quantify with real options, and this is how we've been able to take the decision. And in that case, our decision was actually to take higher risk for higher return. So I think that's yeah, I'm sorry for this lengthy answer, but this is a real benefit from real options. We can access situations others can't.
That's quite interesting, and working regularly with investors, VCs in particular, I see that there's always that big question of the ability to move step by step, because that's what we do through different rounds. But what is usually missing is you have metrics, obviously, but sometimes you tend to apply some generic metrics, gut feeling. A lot of investors have to admit that there's a lot of gut feeling. And the reason being that out of this agile approach we try to put in place, we have no strong methods or rational methods to put a value to the odds of going further. And I think the biggest nightmare for an investor is not only to lose money, but the biggest one is actually to miss that opportunity. And if you're able really to define the right step and the value that you gain of going step by step, then I think that's a huge advantage, because you tend to have a more rational approach. I can see that really applying very well in the travel and transportation, as you were explaining. There's thousands of examples. Today we see a lot of stuff happening in AI with generative AI in general. This is going to completely transform maybe the assumptions or the roadmap that many of the players, I'm thinking about all those OTAs that already invested a lot of money in having AI to have more personalization, better customer support using automation. But this generative AI is, I think, going to be the essence of a new approach, as you need to kind of think about to which extent you're going to invest in it. So today we see a lot of little prototypes here and there, but there's a real question around, how much you're going to invest in that new type of technology as a travel player. How is it going to be part of your core engine? And we're really in the beginning. So that's one case. Another case which we see in Fairval is, for example, in aviation. Aviation is an industry very similar to pharmaceutical, if I can say it properly. Why is that? Because it needs a lot of capex, and there's a lot of steps down the line so that you actually are able to commercialize the product. And so we're working with an aviation startup, really innovative aviation startup. And if you look at the steps they went through, there's this first step, which is, designing something completely new, a new model, which is going to change the way the user experience what we know. And there's different options to do it. So that's the first step, working in the lab, modeling. And once you've done that, you validate your models and so on. You have another step, which is then testing in the labs through wind tunnels, for example, making sure the mechanics work. And then you move to, let's hopefully everything goes well, you potentially start moving to certification. And so certification is a whole process, a certification of your own parts, but also the integration of different parts from other parties. This is quite lengthy, very expensive. And then eventually you could start to do your first demonstrator. Some companies actually now do that demonstrator before for marketing reasons, which is adding more risk in your investment. So that you end up here, so having your demonstrator to validate, to do some tests. And only from there, once you've done everything, you can start to launch commercialization, manufacturing, scale the manufacturing, and so on. So you can see the process is very lengthy. And if you had your design, just imagine inside your cockpit, which is not very usable, because you've done already before all the certification, redoing it all again is really, really difficult. That's why when you take the plane, sometimes you have, devices that looks like devices from the 60s, because it's not easy to change if you look at the certification. So I can see that approach in aviation, which is really deeply being transformed, being very useful for that startup, but in general, many startups in aviation or space tech, because this real offering is really the answer of, guiding in the different steps. And we've been through very difficult discussions and decisions at some stages for this client. So yeah, definitely an interesting one.
Yeah, fully agree. And this is a perfect example because, as you outlined, first of all, there's lots of uncertainty, right? Big investments, uncertainties about on the technical side, product development side, and then on the commercial side, right? Hey, this is, you have no idea about the customer, acceptance of these kind of products, right? And then also you would point out that very naturally this process is designed in steps, right? So that's great. And it's similar to the pharmaceutical industry, which is also a good point because real options actually traditionally started there, right? Because the drug development is naturally staged and the same in the airline industry, right? So these are perfect examples for for the application of real options finance. And as you mentioned, there's so much uncertainty around. You take it stepwise, and you may wonder whether you can find out of critical uncertainties early, like customer acceptance, right? Why should you develop the whole product and find that there is no market? So you may look at this quite early, right? But while you do all this risk mitigation, the question still is it worthwhile? So you need, again, a financial rationale. Here we are again. So yes, taking these agile approaches is very helpful. We still nevertheless need a financial valuation. And, what I've easily seen is such projects, once they're described in their initial design, when you describe this with real options, you find a particular risk and return profile. You find pathways that are very valuable, others that will lose money. And with this visibility, you will be then able to optimize your project, right? you will be able to insert intermediate steps that find out earlier what is critical to you, right? And as I mentioned earlier in my example from the travel and transportation industry, you can also look at optimizing by doing some steps in parallel to be earlier time to market, etc. So this quantification in this kind of settings is clearly very valuable, no doubt. I fully agree
Yeah,
with your
yeah.
example.
Yeah, and again, think about it. In aviation, it takes at least 100 million to minimum to build a new aircraft. So
Yeah,
you need that
exactly.
type
You
of
don't
thing.
even know how
But
much. Yeah.
exactly. So, but listen, there's something which is behind my mind. I'm thinking through is I've been talking with a lot of VCs, and it's hard time for everyone. Um, Raising funds is becoming a challenge for the VCs. So we often think about using real options for actually deciding on to invest or not in a startup. But what is your take how real option could actually be useful for a VC regarding the funds that they're raising for
Yeah.
for investment afterwards?
Yeah, yeah, we'd seen that real options provide us, in combination with this agility aspect, right? They provide us with a great rationale for investment optimization and for improved financial performance. So what we could claim is that this helps for improved fund performance, and this will be, helpful for VCs for their own fundraising to demonstrate that they've got really a governance framework that is very rational, that will actually allow to formalize the projects, the investments, the observations that will be done there, and that actually will even very actively build in further discovery checkpoints, such that once a VC has invested, the VC can then actually have an investment strategy that is not just paying out or paying out stepwise, but actually that is true right sizing, investment right sizing. Because with these observation discovery points, these intermediate discovery points, they can then navigate the uncertainty and decide whether they should stop investing or increase investment or decrease the investment, or call for pivoting, right? So this ability to very actively observe and then right size the investment naturally will enhance the financial performance of these funds. So that's a great pitch when the VCs raise their money. And then it's a great way of operating, right? To follow up on the investments, and overall to come up with very good results compared to their peers.
Yeah, and you're right. I mean, this is really key because sometimes we tend to think about those fund managers to be like gods. But at the end of the day, as any family office and so on, putting their money in the funds of the VC, I think it's quite reassuring to see that there is also some kind of really rationality, well thought process. And I would say it could even be helpful for the first time fund manager who demonstrate that. I mean, he doesn't have yet the experience, but he has also a process which is going to enable to reassure, and also for for their first investors to see how they're managing and communicating their decisions. So I think that's a really relevant point. But listen, you mentioned about portfolio management before, which I think is something which actually applies to all type of investors. So meaning the VCs, the private equity, but of course the corporate investors. Could we just dig a bit more how real option it can be really well leveraged for portfolio management?
Sure, and you're absolutely right. That's a very important point, because when we work on the business case of individual opportunities, what this basically tells us in the first place is just: is this interesting or not? Shall we select that or reject that? And I mentioned before, real options help us to have a good understanding on the overall potential and the overall risks. So when we select it, we know for why, but we also are able to reject without regret. Very important, this focus aspect that Steve Jobs has been, stressing so much. Now, so once we've selected an opportunity, then, actually, we have got probably more opportunities than we were able to fund, right? We have always some envelope available, some budgetary envelope available. Let it be capital, let it be other resources like specialized engineers or whatsoever, right? So we always have some limitations. And so when it comes to actually allocating these scarce resources, let it be capital or other resources, then we have actually to proceed with portfolio prioritization. So within that portfolio, we've got all these opportunities, and we wonder which ones shall get funds allocated, resources allocated, and if we want to optimize overall the financial performance of our investments, well, then we better use financial metrics for this prioritization. And this is where, again, real options help us, because we've got here a perfect matrix adapted to these agile projects. And thanks to that evaluation capability, we can apply typical well-known prioritization metrics. For example, the profitability index, or also the weighted shortest job first metrics that is very well known from SAFE, the Scale to Agile framework. Either way, we need to have the financial valuation capability to feed these matrices, right? And then on this basis, we can perform portfolio prioritization and really proceed with funding. What is important here is that when we proceed with funding, this means that our budget is actually available, defined as an envelope, but it's not pre-assigned. Very important. If you compare to typically what happens in the classic corporate world, you've got an annual budget for all operational stuff, lights on, business as usual stuff, and then even the project budget is predefined for the entire year, right? So this is just a no-go when it comes to innovation. You must not do that. Instead, you must have just an envelope defined, and you make use of this envelope in a dynamic manner over the year, and you make use of it during checkpoints. At these checkpoints, you can update the findings from the projects you've got already ongoing. Plus, you can consider new opportunities and put them in competition for resources for the next funding step, right? And so this is very key. And what's also very key is that you not just have one portfolio, but several. The idea is that that you have got portfolios for various investment horizons. So one investment horizon that is rather suggesting immediate return within the time frame of 1 year. So this applies to maintaining existing products, facelift initiatives for existing products. Then you may have another portfolio for initiatives about next generation products or services or market access or whatsoever, right? So next generation. So the payback period will be a bit later, within 1, 2, 3 years, something like that. And then you may have longer term investments that will be more of exploration nature, right? So you explore what can we do, what are new technologies, new markets, etc., right? And these each of these portfolios needs to have its own budget envelope, such that they don't compete against each other, because otherwise the short term will always gain, right? Because
Yes.
of course it's lowest risk and highest return. No, we need to have a balanced approach, and if you've got, our presence needs to create cash to nurture exploration and next generation. And this is how you can do this with this dedicated portfolio. So you've got a clear view on your balanced investment into those initiatives, right? And each one is then managed, as mentioned, with agility and real options valuation and according prioritization. And then one will feed the other, right? The exploration a part of it may then make it to the next generation portfolio, and then part of the next generation will make it to the actual generation and maintenance portfolio.
Right. So I'll be the advocate of the devil, and I can really having explore real options. Real option has been that fancy thing for really, really intelligent people in one of those big investment banks that we know so well, or those big private equity firms, because it's quite really difficult to apply. So this light thing to use it for capex intensive project was the right thing, but still needed to have really, really clever people. And I think that has been kind of the reason why real option has not really been adopted. What is your take today? Is this still a very elite, very theoretical thing? Sorry to challenge, but I think that a lot of people
It's
probably
very welcome.
will ask themselves this question.
Yeah, no, it's very welcome. These challenges always enhance the discussion, and the answer is actually that you're right. In former days, this was an elite tool because the calculations were not obvious. With keywords here are geometric stochastic processes and volatility estimates with Monte Carlo simulations, and what was even worse, I mean, you can do that, you as experts can do that, but what was even worse in former times is that the business case owners had really a hard time to express their assumptions in a natural way. When it comes to net present value, it was so easy, right? People tell what are the investments, what are the durations, what are the returns, and everybody understood what it was and could discuss about it. So the business case owners could, the decision makers, the investors, everybody could discuss around it and could reach agreement, etc. Right? But with real options, just no way. But this is because the former techniques were actually very much derived from stock option valuation. And actually, this is not a suitable way of proceeding. And since these days, however, there is progress, and actually, I mentioned that the software we are providing actually allows to express the business owner assumptions very naturally, similar to what you know from net present value. So you talk about investments and durations and result probabilities and returns, right? And then the actual calculation is really fast. So these issues are overcome now, and this is based on the fact that in this software, actually this software benefits from or encapsulates 18 years of my own experience in that field, plus recent research results that allow to be really straightforward and to have no longer all these limitations. And nowadays, we can really describe the course of action of an agile project with all its possible pathways very naturally. You can no limitation to binomial trees, etc. You just express it, right? And then you can do all the analysis I mentioned, all this prioritization calculations I mentioned. It's all at your fingertips now. You can hear that I'm proud about this.
So yeah. So okay, because I remember when we worked on it, it was oh my God, it was so complex Excel sheet we're doing with all those formulas, and those trees were huge. I mean,
it's always
it
wrong
was
at some point. There's always a bug. Not in the software.
So
The software is robust.
yeah, so your moment of fame, coming back to your software. So you have developed this software. So is this something that is can you tell me a bit more how you can deploy it? If I'm a VC or or even if I'm a software company providing financial, services. There's a lot of firms that are being now used. Means providing IT solutions to VCs, private equity. How does your software, position itself? How easy is it to deploy, to use it? Can you just give a quick brush on that
Yeah,
point?
sure. So key here is that this software is very intuitive, graphical user interface. It's easy to be used. It's a desktop application at that stage. It can easily interface with other softwares through import and export functionalities. It provides a library of examples you can copy and paste to build your own projects, if you like. And there is, the key point to me is that it allows a natural expression of the business assumption and how the business can go. So this is just fantastic, and it's fast, it's robust. And then you can have any number of complexity in your individual projects, any number of projects in a portfolio, any number of portfolios. As I mentioned, you should distinguish multiple portfolios for various investment horizons. You can, on that basis, perform valuation and optimization for best value creation. You can, as I mentioned, you can consider parallelization for better time to market. You can do an analysis to see where are the weaknesses of your project to make sure that you find out earlier about critical pathways. So once you've done that analysis to bolster your investment decision, you can then use this portfolio level to understand what are the resource and capital usages, and you can perform this famous portfolio prioritization based on financial matrices. Right, and so this is very straightforward, very fast, and most importantly, it's robust. It's the results are financially sound, right? And also the actual calculations are robust. We mentioned that if you ever try to do this under Excel, there are so many mistakes people make. It implements the newest scientific results in terms of real option valuation. So this is all by itself already a great achievement. I've been actually working with a research company in Germany to progress on this. So this is pretty leading edge in all these respects, right? Natural expression of business assumptions, robust real option valuation, truly financial portfolio prioritization. This is all, leading edge. And this can interface with other software for easy integration for those who would like to. So here again,
Right.
you can hear. I'm pretty proud.
Okay, no, that's pretty good. And but however, just to be clear, so you have the software, you have the methodology. Um, um, it's still not. I mean, if I look at all those agility methods, where the biggest questions that people stumble on is what problem they're trying to solve, what's the value they're going to create. So I would think it's great that now we have a good method, good software, but I would challenge that it's still you still need this expertise to feed the software
Sure.
properly, I would assume.
Agreed. I look at this software the name is the real options calculator. It's like a calculator. When you calculate the square root of 5, you wouldn't do that by hand anymore. You've got a calculator, and that's the tool that I'm talking about. The real options calculator is a tool, but you have to feed it, of course, with meaningful business data. So yes, clearly, it is very important that you have got industry relevant expertise at hand. The calculator can be only as good as its inputs. So clearly, yes, and this is where we get back to farewell. I'd suggest, because this is where, of course, all the expertise sits, and we need to capture this within our business cases, and this is where real options come into the game. And and of course, we need to deploy in a very meaningful way the agility methodologies, right? If you look at Lean Startup, it suggests a very meaningful stepwise approach on how to structure your new business creation, right? So here's also some meaningful expertise. If you look at Rita Gunther McGrath with discovery-driven growth, clearly she takes a very similar approach. And of course, if you look at SAFE's Scaled Agile framework, right from the beginning, they said, well, we have to structure our approach in this discovery-driven and agile manner. So yeah, we have to bring all this together, this industry expertise, this agile approach, and real option finance.
Yeah, I mean, just on those just 2 points you mentioned, I mean, we have the privilege, Klaus, to have you as one of the Fairval consulting partners, and we're very grateful. Klaus, you are a very humble person, but I know you're working with, some of the top people working in the agility domain, so you mentioned a couple of examples. Can you just share? I mean, I think it's quite important to see,
Sure.
it's a kind of I like to make sure that people realize that it's a privilege, but also a chance, to have you here on that podcast and all the network you bring together. So please, could you just share with us the other collaboration you have beyond, of course, Fairval?
Well, beyond, of course, Fairval is great. I'm very happy to be with you guys. And of course, as I mentioned, Real Options works together with this broader concept of industry expertise, but also of agile methods. And very naturally, of course, I'm in contact with people in that field of agile methodologies. So to begin with, Rita Gunther McGrath, she's very well known for discovery-driven growth. So she's professor of strategy at the Columbia Business School in New York, and she's a bestseller author and strategy advisor. And I've recently published with her a Thought Spark, and we work together on further promoting Real Options because obviously it goes together well. And similarly with SAFE, the Scaled Agile framework. So I work with the co-founder of Scaled Agile Incorporation, Dean Leffingwell, and his team to actually incorporate Real Options into this Scaled Agile framework. Because it's just obvious and natural, and it's a great pleasure, right? Because it confirms that this is a building block that is a real complement to what is in place right now, which was my initial statement, right? All these approaches, these agile approaches, are helpful, but still we need this building block, this component, this financial component. So clearly, this is what I see with all those partners.
Fantastic. So I think we're reaching the end of that podcast, and I'd like to conclude. I'd like you to conclude actually with the big takeaways, a sum up pitch, let's say, of Real Option. How Real Option really fosters value for us actors in the transport and travel and transportation domain.
All right. Well, in the travel and transportation domain, or in any innovative domain, we need to improve our financial performance of our investments in innovation and resilience. And we know that these endeavors are bound to uncertainty. So we need to take agile approaches to those projects, and we need to have a financial valuation to decide on whether we shall invest or not. And also to decide basically from a budgetary standpoint, portfolio standpoint, whether we shall fund those initiatives and to what extent. And clearly, Real Options are the answer. This is a method that C-level executives should be at ease with, as well as private equity funds, venture capitalists, corporate venture capitalists, lean portfolio managers, and they all benefit from this rationale. And the good news is that while it has been called for quite some time, nowadays it's really available at your fingertips, thanks to our software that we are proud of.
All right. Well, thank you so much, Klaus. That was a very
Thank you.
interesting podcast. Really happy to have you here today. Well, I wish you the best. And of course, we'll probably be interacting through a couple of projects throughout the year. So thank you again, and wishing you a nice day. And thank you to all the listeners to the podcast. Wish you all the best, and we hope you enjoyed that podcast, and we hope to see you again on the next one. Thank you again. Bye.
Thank you, great
Klaus.
pleasure. Bye for now.
Thank you for watching or listening to the podcast, Creating Value in Travel and Transportation, from Fairval. If you enjoyed it, please give it a thumbs up and subscribe to it. We welcome your support, feedback, and suggestions, and we hope to see you at the next podcast. Fairval, creating value in travel and transportation.